my grandchildren are going to inherit a lot of money from me someday. But before that happens, I want to teach them how to build wealth on their own. I want them to understand that wealth isn't about inheritance or luck. It's about making smart decisions, being disciplined, and letting time work for you. So I've told every one of my grandchildren the same thing. If you want to build wealth, you only need 2 index funds, not 10 funds, not some complicated portfolio that requires constant management. Just 2 funds. Buy them. Hold them for your entire life. Reinvest the dividends. Add money consistently. And in 50 or 60 years, you'll be wealthy beyond what you can imagine. Not because you're smarter than everyone else, because you own simple, low-cost index funds and let compound interest do its magic. I'm Warren Buffett. I'm 94 years old. I've spent my life studying wealth creation, and I'm going to tell you exactly which 2 index funds I recommend to my grandchildren. These aren't complicated. These aren't exotic. They're the simplest, most effective wealth-building tools that exist. And if you follow this advice, if you actually implement what I'm about to tell you, you will build substantial wealth over your lifetime. I guarantee it. Before I reveal the 2 funds, let me tell you why I'm such a passionate advocate for index fund investing, especially for young people. First, index funds give you instant diversification. When you buy a total stock market index fund, you own thousands of companies across every sector of the economy: technology, healthcare, financials, consumer goods, energy, everything. If one company fails, it's a tiny fraction of your holdings. Doesn't matter. The index automatically removes failing companies and adds successful ones. You're always owning the current market leaders without having to pick them. Second, index funds have incredibly low costs. The best index funds charge about 0.03% per year in fees. That's $3 per 10,000 invested. Compare this to actively managed mutual funds that charge 1 to 2%. That difference compounds over time into hundreds of thousands or millions of dollars. Low costs are the single biggest advantage of index investing. Every dollar you save in fees is a dollar that compounds for you instead of going to fund managers. Third, index funds remove emotional decision-making. You're not picking stocks, so you can't buy the hot stock at the peak and sell it at the bottom and panic. You're not trying to time the market, so you can't get scared out at the worst time. You just own the market. When it goes up, you benefit. When it crashes, you hold and keep buying. This mechanical, emotionless approach prevents you from being your own worst enemy. Fourth, index funds have a perfect track record of beating active managers. Over any sufficiently long period, 90% of actively managed funds underperform their benchmark index after fees. Professional money managers with teams of analysts, with access to company management, with sophisticated models, they can't beat the index. Why would you think you can? Better to just own the index and guarantee you'll beat 90% of professionals. Fifth, index funds require almost no time or effort. You don't have to research companies. You don't have to read annual reports. You don't have to watch the market. You just buy the funds, set up automatic investing, and forget about them. You can spend your time on your career, your family, your hobbies, your life. Investing becomes a background process that happens automatically. This frees you to focus on what actually matters. Now let me reveal the 2 index funds. Fund number 1 is a total U.S. stock market index fund. The specific fund I recommend is Vanguard Total Stock Market Index Fund, ticker VTI. This fund owns about 4,000 U.S. stocks across all sizes and sectors. Large companies, medium companies, small companies, growth stocks, value stocks, everything. When you own VTI, you own the entire U.S. stock market. The expense ratio is 0.03%, essentially free. Let me tell you why VTI is perfect for young investors. First, it captures the full growth of the American economy. The United States has the most dynamic, innovative economy in the world. We have the best companies, the best entrepreneurs, the best capital markets, the most flexible labor markets, the strongest rule of law. This creates an environment where businesses thrive. Over the past century, the U.S. Stock market has returned about 10% per year on average. Some years up 40%, some years down 30%. But over long periods, 10% average. This is the most reliable wealth building return available. VTI gives you that return for almost no cost. Second, VTI is perfectly diversified. You own Apple, Microsoft, Amazon, Google, all the mega cap tech companies driving growth. You own Johnson & Johnson, Procter & Gamble, Coca-Cola, the stable consumer brands. You own banks, energy companies, healthcare, industrials, everything. No single company or sector dominates your portfolio so much that its failure destroys you. And the index automatically rebalances. As companies grow, they become larger parts of the index. As companies shrink, they become smaller parts. As companies go bankrupt, they're removed. As new companies go public and thrive, they're added. This automatic curation means you're always owning the current market leaders without having to make any decisions. Third, VTI has minimal tracking error. It closely tracks the total stock market index. You get the market return. No surprises. Some index funds have higher tracking error due to fees or implementation issues. VTI doesn't. You get what you expect. Fourth, VTI is tax efficient. The fund rarely sells stocks. It only trades when companies enter or leave the index or when shareholders redeem shares. This minimal trading generates minimal capital gains distributions. You defer taxes until you sell, potentially for decades. This tax deferral allows your money to compound faster. Fifth, VTI is highly liquid. You can buy or sell anytime the market is open. The bid-ask spread is tiny. If you need to access your money, you can sell shares and have cash in your account in 2 days. This liquidity is valuable for peace of mind even if you plan to hold forever. Now let me tell you why I prefer VTI over just an S&P 500 fund. The S&P 500 owns the 500 largest U.S. companies, about 80% of total market value. VTI owns 4,000 companies, including small and mid-cap stocks. Historically, small-cap stocks have outperformed large-cap stocks over very long periods. They're more volatile but offer higher returns. By owning VTI instead of just the S&P 500, you capture this small-cap premium. Over 40 or 50 years, this can add meaningfully to returns. Not huge, but not nothing either. And there's no reason not to own the total market. The cost is the same as the S&P 500. The diversification is better. The potential returns are slightly higher. VTI is the optimal choice. Now, let me reveal fund number 2. It's a total international stock market index fund. The specific fund I recommend is Vanguard Total International Stock Index Fund, ticker VXUS. This fund owns about 8,000 stocks in developed and emerging markets outside the U.S. Europe, Japan, Canada, Australia, China, India, Brazil, everywhere except the United States. The expense ratio is 0.08%. Still very low. Let me explain why I include VXUS in the 2-fund recommendation, even though I've sometimes been skeptical of international stocks. First, VXUS provides true geographic diversification. The U.S. is about 60% of global stock market value. International is 40%. By owning VXUS, you ensure that if the U.S. underperforms international markets for a decade, you still do fine. You're not making a bet that the U.S. will outperform. You're accepting that you don't know which markets will do best, so you own all of them. Second, VXUS gives you exposure to companies and industries not available in the U.S., European. Luxury brands like LVMH and Hermes. Asian technology manufacturers like TSMC and Samsung. Emerging market consumer growth in India and Southeast Asia. These opportunities complement your U.S. holdings. Third, currency diversification reduces risk. When you own international stocks, you have exposure to foreign currencies. If the dollar weakens, your international holdings gain value in dollar terms. This currency effect can boost returns and reduce volatility of your overall portfolio. Fourth, valuation differences create opportunities. Sometimes U.S. stocks are expensive and international stocks are cheap. Sometimes the reverse. By owning both, you're always holding something that's reasonably valued. This balanced approach reduces the risk of buying at a peak. Fifth, international markets have historically had low correlation with U.S. markets. When the U.S. is down, international is sometimes up or down less. This reduces overall portfolio volatility. Now, I'll be honest, over the past 15 years, U.S. stocks have crushed international stocks. The S&P 500 has roughly tripled, while international stocks are up maybe 50%. This has caused many investors to abandon international diversification. They say, why own international when the U.S. always wins? But this is recency bias. There have been long periods where international outperformed. From 2003 to 2007, international stocks beat U.S. stocks significantly. From 1970 to 1980, international beat U.S. From 1985 to 1989, international beat U.S. We don't know which markets will do best over the next 50 years. Your grandchildren will be investing for 50 to 70 years. Maybe the U.S. keeps winning. Maybe international catches up. Maybe they alternate. By owning both, you ensure you participate in whatever does well. You're not making a bet. You're diversifying the bet. And here's the key insight. Even if U.S. stocks continue to outperform, having some international diversification doesn't hurt much. If you're 80% VTI and 20% VXUS, and VTI beats VXUS by 2% per year, your total return is only reduced by about 0.4% per year. That's a small price to pay for the insurance of global diversification. If international catches up or outperforms, you benefit. If it doesn't, you give up a little return but reduce risk. This is smart portfolio construction. Now let me tell you the allocation between these two funds. For young people, I recommend 70% VTI and 30% VXUS. 70-30 roughly matches global market cap, weights adjusted slightly toward the U.S. because U.S. stocks have higher quality on average. This allocation gives you heavy exposure to the most dynamic economy, the U.S., while still diversifying globally. As your grandchildren age, they don't need to change this allocation much. Maybe at age 50, they go to 75% VTI, 25% VXUS. Maybe at age 65, they add bonds and shift to 50% VTI, 20% VXUS, 30% bonds. But the core of 70% U.S. stocks and 30% international stocks can stay constant for decades. It's simple, it's effective, it requires minimal adjusting. Now let me show you the power of this two-fund portfolio with real numbers. Assume you're 25 years old. You have $10,000 saved. You invested in 70% VTI, 30% VXUS, $7,000 in VTI, $3,000 in VXUS. You also commit to investing $1,000 per month, $700 to VTI, $300 to VXUS. Let's assume VTI returns 9% per year average and VXUS returns 7% per year average over your lifetime. These are conservative estimates based on historical returns minus a bit for conservatism. You invest from age 25 to age 65, 40 years. Total contributions are $10,000 initial plus $1,000 per month for 40 years. That's $490,000 you invested. At age 65, your VTI holdings are worth about $3.4 million. Your VXUS holdings are worth about $1 million. Total portfolio value is $4.4 million. You invested $490,000. You have $4.4 million. You turned $500,000 into $4.5 million through consistent investing in two simple index funds. Your compound annual return is about 9.2% after accounting for the different returns of VTI and VXUS. This is wealth building in its purest form. No stock picking, no market timing, no complicated strategies. Just owning the market and letting time work. Now let's project further. What if you keep this portfolio until age 85? From age 65 to 85, you're not adding new money. You're living off the portfolio. Let's assume you withdraw 4% per year for living expenses, and the portfolio continues growing at 8% per year. At age 85, your portfolio is worth about $9.3 million. You've withdrawn about $400,000 per year in total over 20 years for living expenses, and you still have over $9 million to leave to your heirs. This is the magic of compound interest combined with index fund investing. Now, let me tell you what kills this strategy, what prevents people from achieving these results. First, impatience. People can't wait 40 years. They want results now. They see stocks go up 50% and think they can time the market. They see crypto or meme stocks and chase quick riches. They abandon the boring two-fund portfolio for excitement, and they fail. They buy high, they sell low, they end up with mediocre returns or losses. Meanwhile, the person who's stuck with VTI and the XUS gets wealthy. Second, panic during crashes. In a severe bear market, stocks fall 40 to 50%. Your portfolio that was worth $1 million is now worth $500,000. This is terrifying. Your instinct is to sell and preserve what's left, but this is exactly the wrong move. If you sell, you lock in losses. If you hold and keep buying, you're accumulating shares at low prices. When the recovery comes, you benefit enormously. Every major crash in history has been followed by a recovery and new highs. Always. If you panic and sell, you miss the recovery. Third, following bad advice. Financial advisors, media talking heads, friends, they'll all tell you to do something different. Buy gold, buy Bitcoin, buy individual stocks. Rotate into sectors, hedge with options. All of this is noise. It doesn't improve returns. It usually makes them worse through higher costs, taxes, and bad timing. Ignore all of it. Stick with VTI and VXUS. Fourth, paying high fees. Some people buy these funds through advisors who charge 1% annual management fees. On a $1 million portfolio, that's $10,000 per year. Over 30 years, those fees compound to hundreds of thousands in lost wealth. The two-fund portfolio works because costs are minimal. Don't sabotage it by paying unnecessary fees. Fifth, not investing enough. The math works because you're investing consistently. $1,000 per month turns into millions. $100 per month doesn't. If you want to build serious wealth, you need to invest serious money, 15 to 20% of your income minimum. This requires living below your means. Controlling spending, prioritizing savings. Most people won't do this. They'll spend everything they earn and wonder why they're not wealthy. Now, let me address specific questions my grandchildren have asked about this strategy. Question 1, why not include bonds in the two-fund portfolio? You're young. You have 50 to 60 years until retirement. You can't afford volatility. You don't need the stability bonds provide. Bonds return about 3 to 4% long term. Stocks return 10%. Over 50 years, that difference is enormous. 100,000 in bonds at 4% becomes 711,000. 100,000 in stocks at 10% becomes 11.7 million. You give up $10 million for stability you don't need. When you're young, go 100% stocks. Add bonds in your 50s or 60s when you're approaching retirement. Question 2, should I use target date funds instead? These automatically adjust from stocks to bonds as you age. Target date funds are fine. They're better than nothing. But they have two downsides. First, they're more expensive than holding VTI and VXUS directly. Target date funds charge about 0.15% versus 0.03% for the two funds. Over 50 years, this difference is significant. Second, the glide path, how they shift from stocks to bonds, might not match your needs. The two-fund portfolio gives you control to adjust based on your situation. Question 3, what about REITs or commodities or other asset classes? Shouldn't I own those for diversification? No, REITs are already in VTI. About 3% of the total stock market is REITs. You have exposure. Commodities don't generate cash flows. They don't compound over long periods. They barely keep up with inflation. Stocks compound at 10%. Why would you allocate to commodities? Other alternative asset classes like private equity or hedge funds are expensive and don't reliably outperform. The two-fund portfolio gives you everything you need. Question 4. How do I know when to sell? You don't sell. You hold forever. In retirement, you sell small amounts to generate living expenses, but you never sell the whole portfolio. You leave most of it to keep compounding into past heirs. The two-fund portfolio is a buy and hold forever strategy. Question 5. What if there's a depression or a war or some catastrophe? Won't stocks crash and never recover? Stocks have survived the Great Depression, 2 world wars, stagflation, multiple financial crises, pandemics, everything. And they've always recovered and gone higher. The U.S. economy keeps growing. Companies keep innovating. Earnings keep rising. Stock prices follow earnings over time. Yes, there will be terrible periods, but over 50 years, stocks always win. If you don't believe this, you shouldn't invest in stocks at all. Keep your money in cash and accept 3 to 4% returns, but you'll end up much poorer. Question 6, should I try to time the market? Sell before it crashes and buy at the bottom? No, market timing doesn't work. Even professionals can't do it consistently. You'll miss the best days, which often come right after the worst days. From 1930 to 2023, if you were fully invested in stocks, you earned about 10% per year. If you missed the 10 best days over that 93-year period, your return dropped to 8.2%. Missing 30 best days dropped to 6.1%. Missing 50 best days dropped to 4.5%. The best days happen during periods of high volatility when everyone is scared. If you're out of the market trying to time it, you miss those days and your returns crater. Stay invested always. Question 7, what about taxes? Should I put these funds in retirement accounts or taxable accounts? Prioritize tax-advantaged accounts. Max out Roth IRAs first. VTI and VXUS will grow tax-free forever in a Roth. No taxes on dividends or capital gains. No taxes on withdrawals in retirement. This is ideal. If you've maxed Roth, use traditional IRA or 401k. These give tax-deferred growth. You pay taxes on withdrawal and retirement. Still very beneficial. If you've maxed all retirement accounts, use taxable accounts. VTI and VXUS are tax efficient in taxable accounts. They generate minimal capital gains distributions. You only pay taxes when you sell, which you can defer for decades. Even in taxable accounts, these funds work well. Question 8, should I invest a lump sum all at once or dollar cost average over time? If you have a large amount to invest, say $50,000, should you put it all in today or spread it out over 12 months? The data says lump sum investing wins about 2/3 of the time because markets go up more than they go down. But psychologically, dollar cost averaging feels safer. Here's my recommendation. If you have a lump sum, invest 2/3 immediately and dollar cost average the remaining third over 6 months. This gets most of your money working immediately while reducing the risk of terrible timing. Now let me tell you how to actually implement this two-fund portfolio. Step 1, open a brokerage account at Vanguard, Fidelity, or Schwab. Vanguard is ideal because they invented the index fund and have the lowest costs. But Fidelity and Schwab are also excellent. The process takes about 15 minutes online. You'll provide personal information, link your bank account, and fund the account. Step 2, decide your allocation. For young people, 70% VTI, 30% VXUS. If you're investing $10,000, buy $7,000 of VTI and $3,000 of VXUS. Place the orders. They'll execute immediately. Step 3, set up automatic monthly investments. Decide how much you can invest monthly. Be aggressive. 20% of your income if possible. Let's say $1,000 per month. Set up automatic transfers from your bank to your brokerage account. Set up automatic purchases of VTI and VXUS in 70-30 split. Every month, $700 goes to VTI, $300 to VXUS. This happens without you thinking about it. Step 4, set up dividend reinvestment. Both VTI and VXUS pay dividends quarterly. Have these automatically reinvest to buy more shares. This compounds your holdings without you having to do anything. Step 5, rebalance annually. Once a year, check your allocation. If VTI has done really well and you're now at 75% VTI, 25% VXUS, rebalance, sell some VTI, buy VXUS, get back to 70-30. This forces you to sell what's done well and buy what's done poorly. Mechanical value investing. Step 6, never sell in panic. When the market crashes, do not sell. In fact, celebrate. Stocks are on sale. Your automatic monthly investments are buying shares at 40% off. This is when you make your best returns. Convince yourself now, before a crash, that you will not sell. Write down this commitment. When a crash comes, read it and hold. Step 7, increase contributions over time. Every raise you get, increase your monthly investment. Every bonus, invest it. If you start at $1,000 per month and get a 3% raise every year, and you increase your investment by 3% every year, after 30 years, you're investing about $2,400 per month. This acceleration dramatically increases your ending wealth. Step 8, ignore noise. Don't watch financial news. Don't read market predictions. Don't listen to people telling you to do something different. Just stick with VTI and VXUS. Check your portfolio once a quarter or once a year. That's enough. Spend your time on things that actually matter. Your career, your relationships, your health, your interests. Let investing happen automatically in the background. Step 9, teach your kids. When you have children, start them on this strategy early. Open custodial accounts. Invest for them. Teach them about compound interest. Show them how the two-fund portfolio works. Give them the gift of financial literacy. If you start a child at age 10 with $10,000 and add $200 per month until age 25, they'll have about $100,000 at 25. Then if they continue adding $1,000 per month from 25 to 65, they'll have about $6 million at retirement. Starting early makes a massive difference. Step 10, live your life. This is the most important step. The two-fund portfolio requires almost no time or attention. Set it up, automate it, forget it. This frees you to focus on building your career, developing your skills, creating value, enjoying your family, pursuing your passions. Investing becomes a background process that happens automatically while you live your life. This is the ideal. Investing shouldn't consume your time. It should enable your life. Now let me show you what happens with different investment amounts. Scenario 1. You invest $300 per month from age 25 to 65, 40 years. Total contributions are $144,000. At 9% average returns, you end with about $1.3 million. Scenario 2, you invest $1,000 per month. Total contributions, $480,000. You end with about $4.3 million. Scenario 3, you invest $2,000 per month. Total contributions, $960,000. You end with about $8.6 million. The pattern is clear. The more you invest, the wealthier you become. But even modest amounts build substantial wealth over time. $300 per month turns into over $1 million. That's life-changing. Now let me address the emotional journey you'll experience with this strategy, because understanding what's coming helps you prepare. Phase 1, excitement. You open your account. You buy VTI and VXUS. You set up automatic investing. You're doing something smart. You feel good. You check your balance frequently. It's growing. You're making money. This phase lasts about 6 months. Phase 2, boredom. You've been investing for a year or two. The novelty is worn off. The account is growing, but slowly. You check it less frequently. You start wondering if there's a better strategy. Friends are talking about stocks they bought that doubled. You're earning 9% on boring index funds. This phase tests your discipline. You have to resist the urge to chase excitement. Phase 3, doubt. There's a market correction. Stocks fall 15%. Your portfolio that was worth $70,000 is now worth $59,000. You've lost $11,000. You wonder if you should sell. Maybe the market is going to crash more. Maybe you should cut your losses. This is the first real test. If you stick with a plan and keep investing, you'll pass. If you panic and sell, you'll fail. Phase 4, recovery and confidence. The market recovers. Your portfolio is back to $70,000, then grows to $80,000. You realize that holding through the correction was the right move. Your automatic investments during the dip bought shares cheap. You're actually better off than if there'd been no correction. This builds confidence. Phase 5, the first major crash. You've been investing for 5 to 10 years. You have $200,000 in your portfolio. Then a real crash hits, something like 2008 or 2020. Stocks fall 40%. Your $200,000 becomes $120,000. You've lost $80,000 in a few months. This is terrifying. You're bombarded with apocalyptic news. Friends are selling. Financial experts are predicting depression. Every instinct tells you to sell and preserve what's left. This is the most important test. If you hold through this and keep investing, you'll almost certainly become wealthy. If you sell, you'll probably never recover. Phase 6, long-term wealth accumulation. You made it through the crash. You held. You kept investing. The market recovered. Your portfolio is now worth $300,000 and growing. You've been investing for 15 years. You check your balance and realize you're on track to be a millionaire. The power of compound interest is becoming real. This creates a positive feedback loop. You increase your contributions because you see it's working. Phase 7, millionaire status. You've been investing for 25 to 30 years. Your balance crosses $1 million. This is a psychological milestone. You realize that you've built substantial wealth through simple, disciplined investing. You're financially secure. This success reinforces your commitment to the strategy. Phase 8, multimillionaire in retirement. You've invested for 35 to 40 years. Your portfolio is worth 3 to 5 million or more. You're approaching or at retirement. You can live comfortably off 4% annual withdrawals. You have more money than you ever imagined when you started. You realize that the two-fund portfolio, as boring as it seemed, delivered on its promise. You've become wealthy through discipline and patience. Each phase presents challenges, boredom, doubt, fear during crashes. But if you understand that these emotional phases are normal, if you prepare for them mentally, you can navigate them successfully. The two-fund portfolio works if you stick with it through all phases. Let me close with this. I recommend VTI and VXUS to my grandchildren because these two funds are the simplest, most effective wealth-building tools that exist. They give you global diversification. They have minimal costs. They require no research or decisions. They've delivered excellent returns historically, and they'll continue to work for as long as capitalism exists. Will they make you rich overnight? No. Will they require patience and discipline? Yes. Will they turn consistent monthly investments into millions over decades? Absolutely. This is not speculation. This is mathematics. This is proven. Millions of people have built wealth this way. My grandchildren will build wealth this way. And if you follow this advice, you will too. Two funds, VTI and VXUS. 70-30 allocation, automatic monthly investing, dividend reinvestment, hold through crashes, rebalance annually. That's it. That's the entire strategy. It's simple. It's boring. And it works. Start today. Buy these two funds. Set up automatic investing. Then forget about it and live your life. In 40 years, check your balance. You'll be wealthy, I promise.